Hi, I'm Pete Andresen with Andresen Associates, and it's already dark out there. That's what's happening. Welcome to the late fall season. It's supposed to be raining. We've had a report that we're supposed to have a big winter storm. That big winter storm isn't happening. That sounds a great deal like some of the economic data we get. So this week I want to talk about what happened in the financial markets in the last 7 days, and I also want to talk about why I select so many mutual funds. There's a reason why our portfolios have so many different mutual funds. It's not just chaos. This week was really something. People are grasping for information, so we started the week with the interest rates will stay higher longer, stock market will struggle vision, and we ended with during the week we had some really good inflation reports, relatively speaking, but it's not over with. We had some really good earnings reports, and we ended the week with soft landing is about to happen, life is good, interest rates went down, stock market went up, and our bond allocation made as much as our stock allocation in some situations, which means that it's not like the last decade where, since the interest rate was just laying there as essentially zero, you couldn't make a lot of capital gains in the bond market, but now that's changed. So I'm looking forward, if possible, to making gains in the bond market allocations as well as the stock market. That's going to be different. The point that is worth dwelling upon is that we had relatively few bits of long-term, hard-hitting information, and the stock market completely changed its viewpoint, and it probably will change it again. The whole investment community went from one extreme to the next. Let's expect that going forward. Patience pays. Now, why do I invest in so many mutual funds? There's actually a really good reason. When I went through all of the finance courses, you were supposed to figure out correlations, R-squareds, statistics, and you were supposed to blend a portfolio with that in mind, and maybe 12 investments, something like that. Then I had 2000, the year 2000 with the tech crash, and I went through 2007. And what happened was, after 2000, what I learned from that is that when really bad things happen, not the run-of-the-mill downturn, but really bad things happen, all those correlations go out the window, and what matters then is what the mutual fund managers do. Now, index funds are going to do what indexes do, and that is they go up, they go down, completely based on the index. It's essentially a robot manager, and that's fine. You can count on that as part of your portfolio. But actively managed mutual funds, actually some of them have beaten the stock market over the long term. Not very many, but we're invested in a bunch that actually have done that. And the managers don't agree among themselves about what's going to happen. So if you have a high conviction mutual fund, as I witnessed in 2000, that person, like some of the tech funds, will ride that thing all the way into the dirt, a decline of 80%. That was sobering. While the same venue, tech, which started out owning the exact same stock, the fund manager, for whatever reason, will dodge out of the way or have allocated recently to something else and won't have those losses. So what I learned was that correlations go out the window. All that fine statistical work just becomes literally unpredictable. And so I started using a 20 mutual fund allocation. In other words, where I had tech funds, I usually had 2. Because I want those active managers who are in their own right, each of them extremely good. I don't pick bad ones, but extremely good. They're going to behave differently. And that's what I was doing. I was adding diversification. 2008 hit, and it worked. It worked marvelously. Some high conviction mutual funds that are market beating mutual funds, in my opinion, at least they have been, rode it right into the dirt. Once again, 50%, bam, down. Ugly as sin. But since I had diversified into some value fund managers and their mutual funds, we didn't have the catastrophic losses, did we? If you were there, you remember. And we were able to buy. Actually, the ones that ride it into the dirt are sometimes the best ones to buy, and if you can wait, be patient and let that value emerge. But anyway, that's why I developed the 20 mutual fund portfolio as opposed to say 12 or 10 or whatever. Now, that's not the classic formula, but that's why I did it, and it works. At least it works so far. Now, what's going to happen in the next stock market decline? If it's just an average valuation-based decline, it's going to go down. Everything will be okay. But if it's another 2000 or another 2008, like the fear-mongers keep preaching, correlations are going to go right off the wall, and you're going to see mutual fund managers who we have hired to manage our money behaving differently from each other. That's why you have different fund families. That's why we have 20 mutual funds, not 12. Now, that's also why you can see me in recent portfolio action moving from short-term corporates into mid-term treasuries, because I'm turning it into an interest risk only scenario as opposed to credit risk. So you see, I'm doing it right now. Please let me know if you are a client, if you have a problem with the 20 mutual fund portfolio, and we can adapt it. We can give you all the lack of diversification you want. Anyway, thank you very much. Happy Thanksgiving. Enjoy the darkness, and I hope it rains. I hope it rains. And blessings.